We're gonna let a couple minutes more go by, and then we'll get into the meat and potatoes as I see people beginning to to log in. Thank you. This is our first webinar for 2021. I will say this: I am really hoping that at some point um, we are, going to be able to get back to having physical seminars this year. I'm really looking forward to that. As many of you know, if attended these before in person, that's how we used to do it. We shifted to doing the webinars, obviously, in the pandemic, and I have done a few webinars before, but really the physical seminars are great. I get a lot of energy from y'all, but also networking, and it's something that I teach and preach all the time, is the importance of networking. So we are hopeful that at some point, maybe as soon as this summer, we will be able to get back in person with you guys in a safe distance manner, um, where we can sit down and converse, have a glass of wine. But until then, we will continue to do these webinars, and we're probably going to ramp it up. I've been doing one webinar a month pretty much, since 2011, and obviously I'll take a couple months off here and there. But we might look like we're going to probably be doing two seminars, webinars, if you will, a month, kind of going forward this year, because what I've seen uh, is that there is a need to get quality information out in the investment space, especially in the commercial real estate world and investment properties. Because I don't know if you guys are noticing this, but there's kind of two different, and it's probably more than two, but two big different differences in the real estate market, commercial and investment property, and then the single family home. And even in the single family home, like the condos are not selling the same as single family homes are. Single family homes are still rolling, whereas in the commercial real estate world, it's a different ballgame. And so I really think that this year is that year to be, bringing this content to y'all where it can help you out to make some decisions. Okay. And so that's what today is about. And so with that being said, it's about 12:04. You see a few people got in. I'll get going with this presentation. Today, we're going to be talking about selecting your investment criteria. My name is Steve Peterson. I'm the broker owner of Infinity Investments, which is a boutique commercial real estate investment brokerage that I started in November 2009, based here in Oakland. I've been in the commercial real estate business though since 2003. So I've seen the good, the bad, the Great Recession, the crazy, all of that. So I hope to bring my 17 going to 18 years of experience in the business to you guys here today. I also had the pleasure, the honor and the pleasure as serving as president over the California Association of Real Estate Brokers, which is the state board of NAREB, which is the National Association of Real Estate Brokers. That is the Black Brokerage Association. We were formed in 1947. That is the realty. We are known as realtists as opposed to realtors. NAREB was formed in 1947, and we stand for democracy in housing. Okay, and I also served as the president of the Associated Real Property Brokers, which is the Oakland chapter of NAREB, along with being the president of NorCal CCIM in 2018. And what CCIM is, you guys, and you'll see that by my name, that stands for Certified Commercial Investment Member. That is a designation that you can obtain. And it also, more than the designation, you get the designation by going through a series of classes, and you have to do a certain amount of business in the commercial real estate space in order to get the designation. But more than that, it is a network of people. And so I'm a member of NorCal CCIM, and I had the honor of being president, the first African-American president in the history of NorCal CCIM. And that is a great group of people where I've done a lot of business with. So I've learned some things in the business, been around the block, and I want to bring this knowledge to you guys on this topic of selecting your investment criteria. All right. Now, that being said, let's get into this. Oh, I want to just say a couple things. If you have a question, write it into the chat or the Q&A. What I'm going to do, interest of time, is get through this presentation. I got a lot of meat and potatoes. And about at 12:50, we're going to take your questions, comments, whatever. We're going to have some engagement. And by the way, you guys, we are looking to do this hopefully by next month, on YouTube Live. I am 19 subscribers away from getting to 1,000 subscribers on YouTube, which will then allow us to go live on YouTube. So we'll be having these webinars starting next month, hopefully, to get on YouTube Live. There'll be a little bit more engagement for you guys, and a little bit funner format. So if you haven't subscribed to the YouTube station, make sure that you do, so that next month we can bring you this on YouTube Live. That being said, okay, 4 keys that we're going to talk about today in selecting your investment criteria. Hopefully, you all here on this meeting are in real estate investors or are aspiring to be real estate investors, right? Therefore, you need to figure out what you're going to buy, what are you going to invest in, where are you going to invest, all these types of things. So there's 4 key elements I'm going to break down to you today. First of all is preparing your investment plan. Okay, just like entrepreneurs, we have a business plan that we put together for our business, whether we're raising capital for investors or just trying to operate our business. This is something that we do, and often entrepreneurs will update their business plan every year. In fact, everyone I know who is an entrepreneur, we all take some time at the beginning of the year to adjust our business plan. Well, if you're an investor, you need to have an investment plan. Okay, and I'll break down what that is. Also, you need to select your required rate of return. Okay, what you want to earn on your money. A lot of times people just say, I'll talk to them as a broker, and I'm talking, well, how much, what percentage return you want to make? I just want to make money. I want to make as much as I possibly can. All right, so that don't really help me out. That don't really help you out. Okay, so we need to drill down to your specific required rate of return, and I'll break that down. Okay, then we're going to talk about cash flow and depreciation. Okay, 2 very, very important things. I don't think you need to, choose one or the other. You may lean towards one or the other. And I just am a strong believer in cash flow is king. But their appreciation, obviously, here in the state of California, has made a lot of folk wealthy. All right, so we don't want to forget about that. And within commercial real estate, there's some specific things that we can do to enhance that. And the last piece, we'll be talking about the physical aspects of the property. This is important as you map out your criteria and you move forward to making your investment decisions. Because, as we get into it, this is, the one great thing about real estate. These are tangible assets, the sticks and the bricks. Even if you invest halfway across the country or across the world, you own some dirt and a structure on top of it. And so those physical aspects are very important to the overall investment. Okay, so we're going to drill into these 4 things. All right, let's talk about preparing your investment plan. All right, now what I'm going to do is just ask you a series of questions, and I want you guys to think about this as you put together your investment plan. And this is the thing: you want to have a written plan. It don't need to be a 20 to 30 page, in-depth, business plan, investment plan that you put on a software and you're going to be pitching every. I suggest a 1 to 2 pager. Okay, 1 to 2 pager that you write down though, and that you review regularly. Okay, and it starts with this. We got to start with the end in mind. So, where do you want to? Do you want to retire? If so, when do you want to hang it up? And this is a question I ask because in real estate, investing. Look, you can real estate invest all the way into your 80s, 90s. I know people in their 80s willing and dealing. It's kind of like an addiction, and once you get into it, it's hard to get away from it. But for a lot of us, we do need to think about, when do we want to ride off into the sunset? When do we want to kick our feet up? Or maybe when do we want to have someone else managing the portfolio, or just, slow it down a little bit, maybe travel, whatever that is. Okay, we're doing this. We need to be doing this with a purpose. Okay, when we have that purpose, that mission, that's going to drive us through the difficult times. Because let me just tell you, it ain't all peaches and cream. I'm going to keep it real with y'all 100% of the time. If you go to a lot of seminars, you go to a lot of webinars, people might, people might say, hey, they're going to market to you the best aspects of real estate, which there's a lot of exciting things about the business. But okay, there's a lot of pain as well, just like with anything that you do. All right, so make sure that the struggle is worth it, and make sure that you have that mapped out. What do you want to accomplish? When do you want to accomplish that? Okay. And then start with that and work backwards. Okay. Write this plan down, review it regularly, share it with other like-minded investors. Do not share this plan that you put together with your cousin and them, or somebody in your office if you work a regular job, who's an employee and they just put money in the stock market. Do not share this with them, because they don't understand where you're coming from. And that all that's going to do is frustrate you. Um, and for some of you, it might even discourage you. If you're going to share this plan with somebody, I want you to share this with like-minded investors or brokers and agents, someone that you're working with that can help keep you accountable to that plan, and you guys can talk about it. Maybe they have a plan too that where you can vibe with. You got to find that person, all right? And it'd be great if that person is your spouse, but if that spouse or significant other is negative, I mean, you might want to share with them, but don't rely on sharing it with them as your accountability partner. Make sure, this is important, y'all, that you have someone that you respect who is going the same direction that you are going, that you can share this with, all right? Because that helps to keep you accountable. Very, very important. All right, so here's some questions that you need to think about as you're putting your plan together. How much liquid cash do you want to have when you reach the mountaintop? Okay, you're talking about, I need to have $1 million. I need to have $200,000. I need to have whatever. You know what I mean? What is your liquid cash that you need to have? Now, great part of real estate is that it's a tangible asset. The not so, well, I won't say not so great, but the reality of it is a illiquid asset, meaning that it is, you know, it's hard to convert your equity into cash. You do that by selling properties or potentially refinancing and taking some equity out of it. But even if you say, hey, I want to sell my property today and it's a hot market, right? You say, hey, we'll put it on the market, get it sold, get multiple offers. I mean, that's going to take some time. It'll take 2 to 3 weeks of marketing time. It's going to take 30, 45, 60, 90 days to close escrow. Where let's say you used to have some stocks and you're like, I want out. And you call my broker, you can get out in a matter of a day or two or, immediately, right? So real estate ain't like that. However, when you're putting your plan together, it can and it will, if you do it right, bring you a lot of just cash, okay, that you can put in the bank account. What's that number for you, though? Right? Figure that out. Figure that out. And by the way, one person or one type of person you can share this plan with is if you do have a financial advisor, which I actually support 100%. I think all real estate investors should have a financial advisor of sorts that make sure that they have insurance, the right insurances as part of the plan. That maybe has a little balance in terms of having some stocks or some other paper assets, mutual funds, annuities, whatever it may be. Even if your primary goal is real estate investing. Okay, if you say, hey, I don't want to have that, fine. But at least have someone that is advising, because you kind of need to have a number of how much cash you want to have on hand. All right, when you walk away, that's what we're talking about. I mean, or just like I said, when you want to let someone else run it and you kind of just stay on top of them, there is a number that is going to be helpful for you and be more efficient for you if you have it versus not having it. All right. So make sure you have that number in mind. Now, here's probably even more important number is how much positive rental cash flow do you desire coming in monthly? All right. I think this is probably bigger than the amount of cash, because this is now when you do hang it up. A lot of investors make money doing value add deals, buying and selling and doing stuff like that. So when you hang it up, now you're just saying, hey, these assets that I've accumulated over the years is what's going to pay me and pay for my lifestyle, right? So that positive rental cash flow number is important. Let me give you a little bit of insight on me. Okay, so I came up learning this business. Read a lot of the Robert Kiyosaki books, and there's a board game that he put together called Cash Flow. And the name of the game, if you will, to go from the rat race to the fast track, basically, symbolizing, I don't want to say retirement, but the fast track where now your assets are totally playing for your lifestyle. Okay, that what he suggests, there's 2 phases. There's the one-on-one game, the beginner's game, and then there's a 202 Again, that's the advanced game. Okay, in the one-on-one game, you're saying you have to at least have the amount of your living expenses. So let's just say your living expenses is $10,000 a month. You need to have $10,000 a month coming in as positive rental cash flow. Now, um, in the advanced game, it's you need to have double the amount of your living expenses coming in as positive rental cash flow. All right. So that means if your living expenses are $10,000 a month, then you need to have $20,000 a month. I use that number to that because that's for me personally. I got 3 kids. I live in the Bay Area. My living expenses are roughly $10,000 a month when you look at mortgage and food and kids and try to squeeze a little bit of life up in there. It's about $10,000 a month, give or take. So for me, my with it all, my point is when I've got $20,000 a month of positive rental income coming in. Okay, so that number is important. It's going to vary based on other things, based on your situation and your plan. But let me just say this though: in that game, what you learn is that the people with higher incomes, right? Doctors, lawyers, professionals, they typically have a lot higher expenses, right? So it's easier for people who are like, for instance, janitors and business managers, people who have lower expenses, becomes easier for them within the context of that game to move out of the rat race into the fast track. So keep that in mind, y'all, is to minimize as much as you possibly can your living expenses. A lot of investing really is a mindset. It really is a mindset of thinking and living. And what is advised from pretty much all the investors that I know in real life and all the books I've read and courses I went to is to find ways to live comfortably below your means. Not saying that you need to live, uh, um, so rough and tough and, that you're not enjoying life. But there are ways to enjoy life and live at or below your means. The thing you don't want to do is live above them. Trying to impress somebody, trying to keep up with the Joneses. That's not the investor mindset that you want to have. Okay. But whatever that is, look to have a significant amount of positive rental income coming in to cover at least the amount of your living expenses. What I say is double the amount. Very, very important. All right. Now you need to look at what net worth amount do you want to attain. Everybody pretty much says, hey, you want to be a millionaire. I mean, I think everybody and their mama wants to be a millionaire in America, right? And in the world. Okay. But by the time, I'm 38, I'll be 39 next month. By the time I get, 70, which for me is when I want to hang it up there. I'll travel around the world, do all this type of stuff, have fun. But, I don't plan on not doing real estate deals until I'm like 70, man. I love this business. I just want to advance in it, right? But once I get to that point, man, I'm trying time for me to kick back. So what is that net worth going to be? But by the time I get to be 70, which we're talking like 30 years from now, some change, $1 million might not even be that much the way it's going now. So you need to think about that and consider that into your plan, how much you want to be worth. But here's what's more important. What do you want that wealth to acquire? To achieve for you and your family? What do you want that wealth to do? Okay, because just having money to have money, it's not going to fulfill you, by the way. Um, I know a lot of people make a lot of money, millions, hundreds of millions. I got clients, and you know, just having that money is not what's driving it. There's something else going on. So you got to figure that out, for you, right? And so for me, I grew up in East Oakland. Grew up, in poverty in many ways. My wife is from Ethiopia. We really want to, create a better life for our kids. But we don't want to spoil our kids. But we want to also, when we want to hand stuff off to our kids that they can then take and do something with. They can then take and expand and make some serious impacts within our community, within our family, and not just making money and getting money. What is that wealth going to do for you? What is it going to achieve? Okay, and then this is something else to think about. And far too many people in real estate don't have it set up. You need to have an estate plan. And an estate plan that can benefit you while you're still living. If you choose to hand things off to, CEO to run your portfolio, whatever, or your kids to say, hey, kids, I've established this portfolio. I need you guys to run this, so on and so forth. I've got a client who owns multiple properties. He built a big business that, is outside of real estate that allowed him to buy all these properties, make all the investments. I admire him the most because all of his kids are not only successful business people, they all work in his company and they're running the company. And they're taking his company from what he built to like, the super next level. You know what I mean? And he got it all set up, statewise. He's got his trustees and everything set up. So he's actually benefiting from his estate plan while he's alive, and he's traveling, he's doing his thing. I mean, he's still willing to deal in the investment world, but he's set things up the way, hey, when his time to ride, his time to, on this earth is over, and his family's set up, and they're not just set up with the assets, they're set up with the system that he put in place to really grow and do some things. Consider that in your plan. Very, very important. All right. Now, what I think I want you to think about is how much risk you want to take. All right. Everybody's a little bit different. Everybody's a little bit different. If your investment plan is, hey, I want to have $10 million in cash and liquidity, I want to make 100 grand a month, positive rental cash flow. You're going to be probably taking a little bit more risk than somebody says, I want $1 million in cash and I want 10,000 a month of positive cash. All right. But that's based on you. And I think that goes back to the second thing is how adverse are you to taking risks in general, right? Some people have no problem going buying multiple properties, getting multiple mortgages. It becomes second nature. Some people think about a mortgage and they give them heartburn. And here's the one thing. Speaking of heartburn, what keeps you up at night, right? So don't make these moves to where you're it's going to stress you so much that you can't enjoy the process. All right, you got to know yourself on this one, guys. And again, I'm hitting some areas that I just don't see addressed a lot in the marketplace, in the content space, in investment. But you got to figure that out. Everybody's not the same, by the way. Like if you're a lifelong entrepreneur and you've been doing businesses your whole life, you're gonna have a different feeling about risk than someone who's maybe worked in corporate America for 20 to 30 years, or just worked, a job for someone else. You've been doing some things differently your whole life. So you got to take that into consideration and don't just try to keep up with the Joneses, so to speak, because this one guy who's making millions over here. You got to do what's right for you. That's important. And I want to make sure that when we're taking risks, that these are calculated risks, right? We're not gambling out here, and a lot of investors that I know don't even gamble. And if they gamble, for fun or whatever, it's literally for fun. It's not a habit because you don't want to develop gambling habits when you're investing. It's two different things, right? And so what I mean by calculated risks, are you going to take risks in this business, period. But taking risks where you really sit down to look at the pros and cons, the risks and rewards. Okay, can you do what you're trying to do without making this move? Is there an alternative? Can I run this by an advisor? What's the worst case scenario? All these types of things. Those are calculated risks, and I think we all need to be thinking about that. Now, last thing I'll say in regards to risk is that always cover your downside as much as possible. All right, like I say, we're going to take some risks out here when we're investing in real estate, but look to cover your downside as much as possible, making sure you have the right LLC or entities in place, making sure you got a team, with you, legally. And I'll address that, in another part of this presentation. And making sure, okay, you do your property analysis, that you're not just doing things on pro forma. You're looking at the actual historical situation, and then saying, hey, if what's the worst case scenario? Can we still make moves? All right. Very, very important that you always cover your downside as much as possible. Taking a huge loss can really set the progress of your investment plan back. Whereas if you just broke even, for instance, that speeds you up. Now, we don't want to make moves with the intention of breaking even, but we certainly don't want to take losses unnecessarily. We may take losses, part of life, part of business, part of investing, But all we're saying is just to cover that downside as much as possible. A lot of times what I see with new investors, they get excited or they maybe make some money on a deal or see someone make some money on a deal and you just get this bulletproof mentality or real estate is always going to make money. Real estate is cyclical too. It goes up, it goes down, it goes sideways. There's recessions. So just cover the downside as much as possible. All right, now you need to be thinking about what strategies to employ. What strategies are you going to do? Now, I laid the framework with, okay, well, how much money do you want to make? How much money do you want to have? All these types of things, because then that will help you to figure out and maybe to research and learn what strategies are going to be the best for you. All right, that's very, very critical because look, at the end of the day, if like I said, if for instance, if you're saying, hey, I'm gonna get to $10 million liquid cash, 100 grand a month, using that example again, you know, the strategies you employ are gonna be a little bit different than if you say, hey, I want to end up with $1 million a year, $1 million of cash and 10 grand a month. Okay. So there is both plans could be great plans, but that's going to dictate that plan, that end goal is going to dictate what strategies that you use. Okay. And then you got to think about, well, how are we financing these acquisitions? Okay. Are we doing the traditional way, putting 20, 30% down? And again, 35% down, 35, 40% down in most commercial loans. Are you doing that? Do you have the cash? And then are you consistently making the cash to just do it that way? Will you be doing syndications? Will you be saying, hey, I've got some cash, but not enough to do what I need to do. Maybe I need to raise some cash from other investors. Will you be looking at creative financing, acquiring properties with lease options to buy, master lease options, seller financing, joint ventures, things of that nature? Okay. Have you built up an IRA that you can self-direct, where you can use the funds from your self-directed IRA to purchase property? Are you going to be borrowing against a 401k if you have that? A lot of people I know will have 401k, and there's ways they can borrow against that, take that cash and invest in real estate. So how are you going to finance these, acquisitions? And you also might say, hey, maybe I've got under a couple hundred, $500,000 now. I'm going to invest until that's dried up. And at that point, I need to start thinking about exchanges, or I need to start thinking about creative financing, whatever that is, man. I mean, again, it's up to you, but you need to figure it out. You need to come into the game with this planned out. And also for you veterans out there, it might be time to shake it up. Maybe you've been doing deals all by yourself this whole time. Maybe it's time to, do some syndications, or maybe it's time to use creative financing. Okay. You know, uh, Maybe it's time to buy a note. I don't know, but think about in terms of how you're going to finance these deals. And what I would always say is have multiple different ways. Don't just get bogged down into, like, for instance, I know a lot of people that do creative financing deals. And sometimes I look, man, I'm not doing a deal unless the seller's carrying, I don't have to put any money down. I put minimum money down. But then let's say maybe there's a deal that comes across them and it's an excellent deal where it requires them putting more money down. They would have missed out on that deal just sticking with that one strategy. Right. So just keep that in mind. Now, strategy in terms of buying stabilized assets or value added properties. Okay. Meaning that what I mean by stabilized assets, let's talk about apartment for a minute. The kind of break point for stabilized assets is kind of buildings that are 90% occupied. Okay, in our market in the Bay Area, it's kind of, or it used to be at least 95% occupancy. Vacancy rates, by the way, across the Bay Area, across the board, are up. And in commercial, office, retail, they're more than 10%. Okay, and even multifamily, you start to see 10% vacancy rates, kind of in the upper end, higher Class A type properties. But vacancy rates are up. So something that is fully occupied and in decent physical condition, we're going to say that's a stabilized asset. A value added asset is something that's got a lot of vacancy, something that needs a lot of physical work, and you're gonna have to roll your sleeves up. Okay, so what's your appetite? If you're a busy professional, you might be better off doing stabilized assets. If you're going full time, full grind in this thing, and you're trying to build an empire, well, you're probably going to need to do some value add. All right, so consider that. Now, also buy and hold long term. A lot of times, there's a lot of people I know that buy properties and they don't like to sell them. They say, hey, I got this property, I never want to sell it. And what they'll do sometimes is refinance, take some of that cash from the equity they have and use that to go and purchase other properties. Versus, let's say, doing a 1031 exchange where you sell that property, take all the gain and their initial investment, defer taxes, and go buy something else. Everybody's a little bit different. I think you can do both. I think you can buy something. If you got a great one, don't sell it, and you can refi. If you got something, maybe a fourplex you bought, and now you're trying to move up to 20 units, you can do that. I mean, you've got options. So I like to say is keep that buy and hold, value add, 1031 exchange as per property. Every property is a little bit different. So you want to have maybe different strategies for each property. And you always want to make sure you have tax deferral options, right? I did a video recently talking about sometimes it's not the worst case to pay capital gains tax. And what I meant is it's not the worst case, right? It's not the end of the world. And there's actually some good reasons for that. I outlined one of my clients sold a bunch of buildings in 2007. He didn't 1031 exchange. That was a wise move because if he would have exchanged, he would have bought properties overpriced and he would have lost a lot of money. What he did was pay all the taxes and have a boatload of cash when 2008, 9, and 10 came around. So, you can imagine what he did with that cash when properties were pennies on the dollar. However, by and large, you want to be looking to defer your capital gains taxes as much as you can because those capital gains could be one of the biggest killers of your wealth portfolio, especially if you don't plan for and do things right. So there's the typical 1031 exchange, but there's also these opportunity zone funds that have popped up as another alternative to deferring your capital gains. There's other things also like structured sales, installment sales, carrying financing as a seller. But here's what I'm telling you: is you want to make sure you have a tax deferral, strategy as part of your plan. Bottom line, all right, whatever that is going to be. Even if you say at some point I'm going to sell and pay the gains, there's also going to be some point when you need to sell, defer the gains, and buy something. But you got to have that as part of the plan, and that just helps you to be able to think through different situations as they pop up. All right, now we're going to talk about selecting your required rate of return. All right, now this is where we're going to get into. I'm going to start going fast so we can get done with this. But this is where we start getting into how much you want to make. I have way too many people talking to me as I'm a broker, very active, working with a lot of different clients. And first time when I'm talking to a client is I'm asking them what's your required rate of return? What do you need to, what cap rate do you need? What, cash on cash, so on and so forth. What do you need to make? All right. And too many times I get vague answers. Like I was just trying to I need to make a lot of money on the deal. And like I said at the beginning, that does not help me or does not help you. You need to be specific so that we can, be efficient in the way we're going after properties. So some things to think about in terms of selecting your required rate of return is what's your cost of capital. And by cost of capital, I mean, what is the hard dollar cost of the money you're going to invest? And also, what is the opportunity cost of the money you're going to invest? So here's a couple questions to consider in that vein. Where are you getting your money from to invest? Is this cash that you saved up? Okay, is this cash you saved up, but you put it in an IRA and or 401k where you maybe have to borrow from that 401k, right? Which is pretty popular. Okay. Is there an interest cost to the money you're investing? Like if you're borrowing off your 401k, there's an interest cost on that. Let's say you take a HELOC on your home or one of your investment properties, you take a line of credit. Well, there's a cost. So you got a pile of cash, right? Or you refinance property, you got a pile of cash, but there is now an inherent interest cost to that, right? And you need to make sure that whatever you're investing in not only covers that interest cost, but you make a spread. So let's just say you got a HELOC at 4%, let's just say. Well, you better not be making deals where you're going to earn 3% on your money because now you're taking a loss. But to go further, what I would say is if your hard cost of capital is 4%, you need to be making a spread. You need to be saying, hey, I need to make 6 or 7% because you need to plan to make money on that money. Don't plan to break even on money that you borrow. Not a good idea. All right. Now there's the opportunity cost you need to consider. Well, if I invested this money into the stock market, what would I look at? If I invested this money in the cryptocurrency, gold, or whatever. You know, what could I make? So that kind of goes into your opportunity cost. And then there's also like, what do you need to make on each deal to make it worth it? I know, like, one of my clients, he's not going to buy an apartment building. He buys a lot of apartment buildings. He's not going to buy one if he can't make $1 million on the property in a 2 or 3 year period of time. When I first met him back in '08, I was like, man, that's crazy. But I've seen him buy building after building after building after building after building, and he's makes that $1 million. He's not, so therefore he's not going and buying fourplexes and stuff. And if he does, that might be something that he buys as a part of a bigger portfolio. But that's not what he's going after, because he said, I need to make this $1 million on every deal. All right. That guides him through his decisions. All right. And then what do you need to earn annually to be in line with your plan? You got to consider that. Or you got to consider that, because if you when you put your plan together, what your earnings have to match up with that, or it's just you just pie in the sky, and you're not going to get there. Okay, so now we'll drill into some specific measures of rates of return, because we need to consider this. Okay, when we're going out and buying properties, we need to look at what the capitalization rate is. That's the cap rate. Basically, that's the rate of return generated by a real estate investment property based on the annual net operating income that a property generates. And the formula, how you calculate the cap rate, is net operating income divided by the value and or the price of the property. Value could be for properties that you're evaluating, and or your property, you're trying to make some evaluations on it, or basically if you're negotiating for a new acquisition, it's going to be the price that is being marketed or the price you pay. Okay, that cap rate though is what the property generates. It does not include the debt cost, the what we call debt service. That just is what the property basically, if you pay cash for this building, the cap rate is what you make annually. That's your annual need, your annual yield. Okay. The thing that might be more important to you is your cash on cash return. That really is how we look at in the business, is your annual return on investment. Okay. In order to get to the cash on cash return, we need to determine what the net cash flow is. The net cash flow of the property does consider the debt service, because the net cash flow is simply the cash remaining after all expenses, that's operating expenses, and the mortgage is paid. Okay. The cap rate is just looking at the net operating income in relation to the price of value. The cash flow is looking at the net operating income minus the annual debt service, the mortgage payments. That's your net cash flow. Because most of us are going to have mortgage payments on our properties, right? That's a very important number. And the way we measure the performance of that cash flow is we look at the cash on cash return, which is the net cash flow divided by the total cash invested. And that is your down payment plus any of the closing costs. Okay. And the formula for that is net cash flow divided by initial investment. And that's your cash on cash. Okay. That number, is what you're going to make on your money annually from a cash flow standpoint. Very, very important. You need to figure out what that is. A lot of people, back in the day are saying we need to make 10% on that. Nowadays market got tighter. People, I need to make at least 6%. You figure that out based on the plan, like we just talked about. Then there's an internal rate of return. I won't go into this as much, but essentially the IR, and this is known as IRR. Okay, the internal rate of return is simply the total return on an initial investment on an annual basis once the property is sold. And when I say total return, what I mean is this: the annual cash flow during the life of the time you own the property. Every time you make a mortgage payment, there's something called principal paydown, which is an interest-only payment. But most payments are, when you make that mortgage payment, you get principal paydown. That's an element of return. Okay, hopefully the property over the life you own it is going to go up in value. That's appreciation. And then there's going to be either a tax benefit or a tax liability. That's what we're talking about, the total rate of return. For most of us, I think we should focus on what our cash on cash return is going to be. But for you guys who are looking at big value pops, the IRR is important. Okay. And I go into detail on this in some of my videos and other presentations. But I just, I'm going to touch the surface of that, because I think we need to be more so concerned on our net cash flow and cash on cash. Now, the speed of your plan, basically, how fast you want to get to that end goal, is going to kind of determine the types of returns you need. Okay, if you're just trying to get to $1 million in 30 years, then you can get by with making 5 to 6% on your money. Okay, if you're trying to get to that $10 million spot, you probably gonna need to make a little bit more on your money. Okay, and that's basically goes to that. I mean, this, the faster you go, the more risk you will take. Though, keep that in mind. The faster you go, the more you want to make, the more risk you will take, and a loss can set your plan back um, a lot. So make sure that these risks are calculated and not pure speculation. Got some facts and figures to back up the risk that you're taking. Okay. Slow and steady is typically always best though, but if you are doing slow and steady, still don't be afraid to take the right risks. Okay, I want to make sure I point that out. We're look, you invest in real estate, you get mortgages, you're taking risks. Okay, just make sure that they're the right risks. Don't be afraid of them. That's why I keep talking about calculated risks. Now, another thing is market timing. All right, when you buy, when you sell, all of these things, very, very important. Nobody has a crystal ball, but there are some indicators that can help guide you through this. All I'll say is this: there's a great book called Timing the Real Estate Market by Craig Hall. That's a book you should have as part of your education. Timing the Real Estate Market by Craig Hall. Really great book about it. And he goes back like to the 50s. He's been investing since the 50s to now. And he goes through all the different segments of the market and the times he's won, the times he's lost, and he breaks that down. Very, very good read. So that's important. Market timing, very, very critical. Now, we always talk about, we want to talk about minimizing your downside risk. There's risk, right? But here's a couple strategies that you can do to minimize the risk. First of all, always consider the worst case scenario in each deal that you do. All right. I'm a positive cat. I believe in being positive, right? So as an entrepreneur, a lot of times we also are confident. And so as entrepreneurs, we think, hey, we can make it this happen. Well, this business over here was producing X, but I can do more than that because I got this great formula. I'm so great, so on and so forth. That's what we think about. That's how entrepreneurs think. As an investor, a little bit different than an entrepreneur. Okay, still be positive, but you need to be a lot bit more critical. Okay, when you're investing, in real estate particularly, and you need to consider that worst case scenario. Like for instance, can your property still cash flow if there's a large increase in vacancies? Okay, or are you going to be negative cash flow? All right, is the area you're investing in growing or is it dying? Okay, right now, a couple years ago, everybody wants to be in San Francisco. The prices in San Francisco are outrageous. People are moving out of San Francisco in droves. Who would have thunk it? Not to say that it won't come back. I'm sure the city will make a rebound. But right now, the rents have come down in the city tremendously. People moving out of there, and then there's other areas where people are moving and there's growth and there's population growth and there's job growth and all this. So you need to consider that. Don't just, like, for instance, if you're investing out of the area, don't just buy something because it's cheap. You got to buy something because it makes sense. Very, very important. Don't over leverage your property. Okay. Make sure you don't do that. Do not over leverage, man. Keep the proper amount of leverage, and also don't cross collateralize. Now, there is a time possibly to cross collateralize, but understanding that's when you get a loan that encumbers multiple properties in your portfolio. It is tough when you do that because one property goes bad, it can affect the other properties. I just advise keep your liens property specific. If something goes bad on one, at least it don't affect the other ones. Okay, you do what you do. My 2 cents. All right, and then also be very careful with hard money loans because they're very high interest. They are not banks. Hard money lenders have different intentions than banks actually don't want to take your property back in foreclosure. I mean, they will. That's not really a good thing for them. Hard money lenders, they ain't tripping off that because they don't have the same regulations that banks do. They wouldn't mind taking your property back because they lent you money at such a low loan to value that they know typically they're going to make money when they take it back. Also, when you're raising capital, just make sure you follow the rules. Make sure that you got an attorney if you're going to raise capital, you're putting the LLC and the documents together the right way, and you're selecting the right partners, okay? Make sure you got a good attorney and a CPA on your squad to help you be able to do that, all right? Always minimize the downside risk. Don't be so positive that you blinded to the risks and the pitfalls of this game because there's a lot of them, all right? As I'm talking about cross-collateralized, I'm dealing with the guy in the portfolio right now. He's got a loan basically encumbering 4 properties. It's a little bit of a mess. All right. So it can happen. It's real. Stay focused. You always want to be positive and ambitious, but you got to dial it back, when you're doing this plan to figure out what's the worst case scenario and minimize that risk as much as possible. All right. Now, and I'm going to wrap this thing up in the next 5-10 minutes, but Now we're going to talk about cash flow and appreciation. So very, very important. I think what's going to drive your desire for cash flows is going to probably start with where you are now. What is your current earned income or business income status? And I say business income, I always like to teach and preach entrepreneurship. It is different than working a job for sure. But either one, you can be making a ton of dough, at a job. You can be making a ton of dough at a business. Okay. And so if you're making millions or hundreds of thousands, right, your investment goals might be different than somebody who's making 50, 200,000 scraping by, and they're looking at investments as their way to make it big. If you're making excessive cash flow, you're looking at investments possibly to, maybe make it bigger, but a lot of times you're like, I want to preserve my capital. I don't want to lose this money out there. All right, I want to grow this money. I don't want to cat it off. I don't want to lose it. I want to take this dough and expand it. But it might be different if you are barely getting by with your earning income because you're like, look, I'm in this business to strike it rich or to make it big leagues, to go to the next level. Where are you at? And here's the deal: forget about everybody else. Forget about them. Look at you. This is not a sprint. It's more like a marathon than it is a sprint, but it's not even a marathon. It's about you, your family, your legacy, the end goal that you're trying to get to. Forget what other people in the marketplace, somebody you seen on Instagram, I bought all these properties and blah, blah, blah. That's cool, support it. But what I'm saying is don't get caught up in the hype like you need to compete with them. Look at your situation, all right, and make decisions accordingly. Also, what do you enjoy or what do you hate about what you do on a daily basis in your business or in your job? Some people like, man, I just want to get off of this job so that I can just invest in real estate. Like me, I run a brokerage. I enjoy brokerage, but I would like to get to the point where I've got a CEO running my brokerage and I'm doing real estate investments full time. I like to see that happen in the next 5 to 10 years. I enjoy brokerage, but I enjoy investing in real estate more, right? So what is it for you? Also, where are you at tax wise, right? If you're paying like 40 something percent of your taxes, you're gonna start being like, hey, look, I'm not trying to make a crazy amount of money in real estate. I'm trying to put my money in safe places and minimize my taxes. Versus you ain't making no money, like I don't mind paying taxes because that means I made money. So just consider that, and then also consider how confident you are in your business or your earning income, the way you make money. And if you're in a business or you're working for somebody, just consider look at this pandemic that could change drastically, right? Like for instance, 24-hour fitness was an amazing, great business before this pandemic, and they scrapping and hanging on. I like the fact that they're scrapping and hanging on. They're not closing it out and just walking away. They're scrapping. But this, I think the income projections for 2020 were totally different before that pandemic hit, right? So just consider that, and as you're thinking about cash flow versus appreciation when you make your investments. Now, that kind of goes into, are you looking to preserve your capital or seriously grow it? Um, like we just talked about, you're making so much money, you're just trying to stick it somewhere safe. And that's how like a lot of us will think, well, why do people buy properties at a 3 cap rate or 4 cap rate right now? A lot of us, oh, that's just stupid. Because, well, I'm not doing that. But a lot of people who do that are saying, look, I'm making so much money over here. I'm doing this 3 cap rate because it's the right neighborhood. It's the right property. I think I put my money over there 10 years. It's going to grow. It's going to preserve. That's a different mindset than somebody's like, man, I just made a couple hundred on the deal. I'm trying to make it to a couple million. All right, I'm trying to take this money. I need to take a little bit more risk, right? So that then goes into, right, kind of how ambitious are you? How concerned are you with long-term growth of capital or preserving it? And what I mean, are you just starting out, or you already got an established portfolio? And I know investors, like one of my top guys, he says when he does an exchange, 1031 exchange, his criteria is a little bit different because he's in the top bracket. So he's not trying to pay 40, 45% in taxes, right? So he will make a little bit less on that deal than he would if he just was using regular cash to invest. That makes sense? I want to make sure we hone that in. I see a couple of you guys have questions in the chat. We will get to them. All right. Now, will you spend your cash flow or will you reinvest it? All right. Now, here's what I really mean. Are you looking to live off your cash flow before you reach your final goal? Once you reach your final goal, that is the time where we say, hey, look, we this is grocery money, this is mortgage money, whatever it's going to be. Um, but kind of building it up to get before you get to that point, I think we need to be coming up with a plan on how to reinvest that cash flow into your properties or, just stacking up that dough. However, I say that because there might be some of y'all like, look, man, I'm not making enough money in my job. I'm trying to advance the money. I'm trying to make this cash flow so that I can have more money, in my bank account. Okay, so that's real. And like I said, I like to keep it real in this stuff. So that may be the case for you now. But as you consider, as you grow, as you expand, you got to make sure that you are investing back into your properties, because if you don't, at some point it's going to bite you, man. It's gonna bite you. And and if also, here's another thing: investing back into your property, but also putting some money in the side, in reserve, liquid reserves, and also maybe putting some money in other markets. Maybe you want to put some money in the stock market. Maybe you want to put some money in cryptocurrency. Maybe you want to put some money in gold or in silver or whatever. All right. Your cash flow is a great place to be able to do that. All right. But that's going to kind of depend. Like if you're like, man, I really, really need cash flow now. I need cash flow now. And you may be different investing in a different market than, let's say, the Bay Area. You might be investing in the Central Valley, California, or somewhere in the South or Southwest regions of the country, because you're going to get more cash flow on your dollar. All right. And maybe you don't need that money now, but you just feel more comfortable with more income coming in because you don't like the fact that, look, if a couple tenants don't pay, I might not be able to make the mortgage payment. Right. So you figure that out. And I think that's going to help figure out what markets you're going to be investing in. Okay. Because that's a whole nother thing to consider. We'll talk about that here shortly. But just understand that you need to have a plan for your cash flow. If the plan is to spend it, fine. But I say you need to put some of that money aside, or at least stack some money up. If you want to spend it, stack some money up first, then spend it. So you have some reserves if someone wants to pop off at one of your properties. Very important. All right. Now, location. We're here in real estate. Location, 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 right? It is important. And I think where you're going to invest is going to be a factor of your plan. Okay. Like what I said here, you're looking for, locations, growth or areas or solid and steady area, class A, which is like high income area, or like I put it here, a turfed out area, where, war zone type neighborhoods. So, are you investing in your backyard only, where it's like an hour drive radius, or are you wanting to go out of the area, right? So I think that goes to what's more important in regards to the plan: current cash flow or long-term appreciation. You figure that out based on what your plan is. There's not one that's better than the other. I just think that the great thing about commercial real estate is you can make your cash flow, and you can also force the appreciation of the property by increasing that net operating income. Okay, so that's a great part of what, why I love commercial real estate over residential. All right, now there is this thing though. A lot of people just will only invest in their hometown area. And I understand that, because having invested out of the area, it can be a pain. You have to hop on a plane, or you have to drive far to, go see your property, versus just taking a half an hour to an hour drive to manage what you got. All right. But you make a lot of money by investing out of state, especially if you sell a property in California. Let's say you go buy something in Georgia, you can triple your cash flow that way. But you got to be understanding of, if you're going to do that, you have to have the right management team in place. So, and also, here's another thing: what cities and neighborhoods are you comfortable with in terms of investing? Like, I'm from East Oakland. I don't have no problems investing in East Oakland, working in East Oakland, selling properties in East Oakland. I'm comfortable. You know what I mean? I'm doing a lot more business in Stockton, where I don't know the neighborhoods yet, but I would say in Stockton, I'm now comfortable with the downtown area because I've done enough deals there. I've been there enough time, researched the area. When it comes to South Stockton, that's a much tougher area. I don't know South Stockton like that. You know what I mean? So I'm not as comfortable with that. All right. But I'm comfortable that, so therefore I can make decisions based on that. And I want to be able to sleep at night. I don't want to be stressed out. So you want to think about what cities and neighborhoods do you feel comfortable with? Not necessarily what cities and neighborhoods do you going to live in. All right, like I said, East Oakland. I'm born and raised in East Oakland. I do business and deals in East Oakland probably for the rest of my life. I'm probably not living in East Oakland no more, because I did. I can't. I mean, I came up that way, right? I bought the Oakland Hills. It was always my dream to live up here in this neighborhood, and I'm here. This is where I would prefer to live. I'm probably not going to invest in this neighborhood though. And I can see there's not a lot of where I live, there's not a lot of deals. You know what I mean? It would have to be like a flip deal, not an income deal. So what I'm saying, cities and neighborhoods that you're comfortable with, and not necessarily where you're gonna live at. So I'm gonna wrap this up real quick. I know we're almost at. I want to leave time for your questions. All I'm going to say is we're talking about the physical aspects of the property. You got to consider that. Okay. Value added or stabilized assets, I think is the biggest thing to think about. Are you going to be investing in value added deals? Are you going to be looking to make big pops? Okay. That means you have to have construction experience or someone on your team with the construction experience. Don't just go into that and you don't have anything or anybody that knows about construction. Contractors will take you to the cleaners if you don't know what you're doing. Okay. You can make a lot of money with value added properties, but you need to know what you're doing. And if you don't have time to deal with that, you're probably better off staying with stabilized assets, like we talked about before. All right. Roofs. All I'm going to say here, I won't go read this whole thing, is a lot of investors don't like flat roofs. Here in the Bay Area, we have a lot of them. And so, don't not do a deal because of flat roof. If it's a really good deal, but you may want to just know that it's going to be a pain. And if it's not new, you may have to replace it while you own it. And if that's the case, just budget it into what you're doing. Okay. The style of construction, not that big of a deal. It goes into your preference. In apartments, you got things like garden style, mid-rise, high-rise, style of construction, stuccos, is it wood, whatever. You know what I mean? Here's what I would say is make sure that with the style, because like, for instance, a lot of apartments are like that outside hotel style. The people don't like that as much as like the interior corridors here in the Bay Area. But like say for instance, if you're in an area like where it rains and it snows a lot, you may not like the interior corridors, or you might like them more. The key is making sure that what you get is still in demand for your area. Right? It's not about what you personally, want. It's more about what the demand is in your area. Also, this is just a little thing to think about. High-rise living losing its luster during this pandemic. People moving out of San Francisco, people moving out of New York. Condos are not selling the same way as single-family houses are selling. Now, that's now in this pandemic. Will that trend last? It'll be. I don't know. It'll be interesting to watch. I just figured I'd throw that out there to you. Last thing, consider the foundation, the plumbing, the electrical, parking, lot size. Okay. One thing in California, avoid brick foundations if you can. First of all, you ain't gonna get a loan on them unless it's a private money loan, you probably need to retrofit it if it is a brick foundation, because if we have an earthquake, the building can probably collapse. All right, and you want to make sure and watch out for faulty electrical and plumbing systems. That's a standard stuff. I just wanted to make sure I put that in there. Is there parking? Can you charge for parking? Right. And this is the thing I wanted to say on physical aspects of the property is simply just making sure that you're looking for properties that have lots where you can build on it. Especially if you're in a densely populated area like the Bay Area, you can make a ton of money by adding on additional units. And typically when you add additional units, they're not subject to rent control, meaning that you can make more money on rents. Okay, so please consider that, you guys. That brings us to the end of the presentation. I want to take some time to answer your questions. I'm sorry, it's a lot of information to cover in an hour. Again, we are almost at 1,000. This is a picture of our YouTube station where we were about, Jesus said 791 subscribers. I think this picture was taken about over the summertime. We are now at 981. Once we get to 1,000 subs, we will be going live and doing these webinars on YouTube Live. Okay, so now what I want to do, stop the share, and I'm going to get into your questions. All right. Here's what let me see if we have anything in the Q&A. Nothing in Q&A, and let me go in the chat. And if you do have any questions now, I see we still have a bunch of people on here. Ask away. Varesh Dave asks, is it possible to share the slides? Absolutely. We will share the slides to everybody who's registered for this event. We're going to send out, what we're going to do is we're going to send out the recording of this event along with the slides. So you will get a recording of this event along with the slides. In that email, we'll also have a Calendly link. If you would like to book an appointment with me to discuss, real estate investing goals, criteria, plans, whatever, make sure that you book an appointment with us, because I think we take 20 or 30 minutes, we talk about what you're doing, we can come up with a really good plan and strategy. Okay. And that's every time we do something, we always want to make sure we put the content back out there. So like this will be emailed out to you guys. This video will be on YouTube. You'll get all the presentations and slides, and and make sure. I mean, I'm really into like feedback and learning myself. So like if there's something in there, say, hey Steve, man, this is really helpful. Or maybe, hey Steve, can you talk about this one on the next one? That will be ideal because that it helps me out a lot and it helps me to be able to, create this content. My goal in this, y'all, is that I am doing this type of content on a consistent basis. This is a little bit longer. Okay, obviously this is a webinar, but I'm doing, 5 to 10 minute videos, 10 to 20 minute videos on a consistent basis with the idea of addressing problems, issues, concerns, trends in the marketplace. And I think that's something I've been doing for a while, something I love to do. But I also think as we're in this pandemic and whenever it ends or whatever, we're going to see some shifts in what's going on, right? And so that we need to stay ahead of it, and that's what I intend to do. And what helps me out from you guys, the marketplace, is to say, hey, can you address this topic? Can you talk about this? So on and so forth. And when you guys do that type of stuff, I will be on it. And we got a couple more chats in here. Rick, okay, Marvin Evans asks, do you have a mastermind group? Do you share any deals that your main investors don't jump on? Well, I don't necessarily have, Marv, great question. I don't necessarily have like a mastermind group, if you will, but I do, I'm brokering deals all the time. And, I definitely will share deals that folks don't jump on one way or another. So what I would say, Marvin, let's book a time to talk, and then we can figure out how we can, now let me just say this about mastermind. I like to mastermind with all my clients, right? And then what we do is I like to take an approach of, I'm not just trying to find a deal for you. I'm trying to, move forward your portfolio. So the deal that I find for you is in line with that plan, right, that we talked about. And so that whole process is a mastermind, kind of on a one-on-one basis. What I will say, you brought this up. I've been asked by a few people, hey man, can you put together a mastermind? Can you can you do some mentoring and all that? So I'm thinking I'm creating as I go what my next moves are going to be. I'm also, heavily involved in the market as a broker, also as an investor. So, as I grow and expand my team, I think we'll be able to, service you guys better in terms of having ideas and stuff like that. What I do for people who are looking to learn the business, I am growing my brokerage, asking people, say, hey, look, why don't you join our brokerage or at least become a part of our ecosystem, because we do regular trainings to our team on a weekly basis. And that, you know what, our team in essence is kind of a mastermind, but that's more of like agents and other brokers that we're doing deals. So maybe putting an investor mastermind might be something to consider. So great point though, Marvin. But make sure you book an appointment so we can sit down and talk and we can collaborate. All right. And Rick, Rick, thank you, bro. You say you're doing good. I really appreciate that. Jackie Williams says, I've enjoyed the webinar immensely. Oh, thank you, Jackie. Appreciate that. The material's off the charts. What is the best investment for someone looking to use real estate as an investment vehicle? So, what I'm going to assume is that we're talking about like what kind of real estate, right? And if I'm not, if I'm off, let me know. So I like apartments. I like apartments. My typical, I won't say my typical, but my bread and butter presentation is like the introduction to multifamily and commercial investing. I kind of break down why I like apartments, but just quickly, I like apartments because when times are bad, the vacancy rates are not going to be as all bad as, like, let's say, hotels, retail, office, like there is now. Like, for instance, in Oakland Bay Area, vacancy rates are way up on office buildings and retail buildings and hotels, whereas they're a little bit up on multifamily, but not so much. Also, financing is easier to obtain on multifamily. Now, multifamily versus single family, I like, because it gives you economies of scale. Let's just say you got 10 units, 2 people move out. Now you got 2 vacancies, but you got 8 units continuing to pay you rent. If you got a house and it's rented out, when that person moves out, you're 100% vacant until you release it. Now, I think houses can be great. So I think if you have houses, rentals, they should be used as a stepping stone to move into multifamily, either 2 to 4 units or 5+ units. I know some people who have home rentals that they really love, and the values go up. I just think that homes get to a value point where the cash flow is not as substantial, but you can make a lot of capital gain on homes. You can also like make a lot of money flipping property to earn you the cash to then invest in your rentals. But understand this, like to speak to your point about investment, retirement, is that you really need to develop cash flow, positive rental cash flow, if we're talking about retirement, because that will, and that retirement means different things for different people. But what I think about it is that my assets are paying for my lifestyle, not my capacity to earn. Right. So now, like for instance, I run a brokerage. The buildings that I own paying for all of my lifestyle versus all the properties that we sell. Now in brokerage, you can get to the point where you have somebody running the brokerage and you have somebody, managing things, and you can make passive income from real estate brokerage. Actually, a lot of people don't know that. I'm still trying to get there, by the way. But what I'm really looking at is that it's still, when you're running a brokerage, even if you got somebody running it for you, got to stay on top of them. All right. And in properties, for instance, even if you have properties, there are people managing, you still got to be engaged with what they're doing, but not necessarily on a daily basis. And so I think that when you're talking about retirement, you really want to focus on generating passive income. I think the best way to do that is through multifamily apartment buildings. If you're starting out, start with 2 to 4 units. Start with 2 to 4 units. Financing is better, and then move your way up. You got a couple of duplexes, triplex, fourplex. Then when time is right, you sell those, and then you exchange up to some apartment buildings, 20, 30 units. That is an excellent formula to and really speed up the process of getting to retirement. And think if you ever play Monopoly, that's like trading in your 4 green houses for that one red hotel. Where now you're gonna get more cash. It literally is the same concept. I've been teaching that to my kids during this pandemic. We're doing a lot of board games to try to get them off of the video games and the screen. And it's something that kids can understand in the sense of a game, but it's the same principle for us, living the day-to-day life of investing. So let me see. I think there might be one more question. All right. Jackie says you gave me the answer. Thanks a million. We'll definitely keep in touch. Keep up the good work with the kids. Thank you, Jackie. Appreciate it. And I appreciate you all. This has been fun. I hope you got something out of it. Now, a couple things. Next one I'm going to do. So we always do. So when we do our seminar, it's going to be the 4th Wednesday of the month at 12 o'clock. I'm going to do a joint seminar with Jason Matthews of Matthews Financial. Now, we're going to be talking about taxes and the Biden tax plan, how that may or may not affect real estate and commercial real estate. It definitely probably is going to affect us some way or not. And it's not about time, the Democrats in there taxing everybody or law. It's about figuring out, hey, what's going on? What are the plays and the moves that you can make, during that time? So that's going to be February 10th at 12 p.m. We're going to get that, marketing out probably tomorrow. That'll be the next event. And then for our next seminar, it will be February 24th at 12 p.m. Okay, I haven't come up with the topic yet, but those will be our dates. Stay in tuned. Thank you. Oh, Ricky says create the kids' Twitch channels. I got to do that. And then Aki Raheem said, "Oh, thanks, Steve. Great info. Thanks, Aki, man. We got to chop it up, touch base. I really appreciate you guys. I'm gonna log it off for now. Like I said, this will be emailed out to you guys. You get a copy of the slides. Book an appointment so we can talk shop and we can figure out how you're gonna take over the world with your investment plan. Thanks a lot, you all. Have a great day. Best of success in your investing career. Peace out.